discuss some of the stocks and how do the fundamentals stack up. Pankaj Pandey, the head of research at ICICIdirect.com, joins us on the show. Pankaj, let's start with ITC itself. What are you making of the merger? A bit disappointed by the complicated structure or the fact that the news is finally out? That is something to watch out for.
So, hi, good morning. Thanks for having me. I think this demerger is a bit of a sort of a disappointment, largely because a vertical split would have been a lot more better from an investor perspective. But I think from a per share perspective, hotel business was contributing over 25 rupees. So probably from a number perspective, it does not really sort of matter much. But I think overall, it's a bit of a disappointment because you're still holding at 40%, and it is very much possible going forward that this business will require money, and capital allocation could remain the challenge which has been there for a good period of time. And so from that perspective, yes, it's a bit of a disappointment, and I don't think we'll be sort of raising our target prices because of that. Bit of a letdown in terms of expectation.
Pankaj, what about the outlook when it comes to the entire metal sector, owing to the fact that you have seen a bit of a decline that has set in? What's the outlook on where you see metal stocks headed?
So I think on metals, we still don't have a very clear trajectory in terms of how China will sort of perform. So while you see the volume growth being good, especially on the domestic side, whether it is for Tata Steel or for JSW Steel, I think the pricing is a sort of a challenge. So which is where I think things are yet not clear, and Chinese rebound in the economy is still sort of soft. While you will get a benefit of lower coking coal prices from Q2 onwards, so that will sort of lift the overall EBITDA per ton. But our sense is that metal still, as an overall space, we would want to sort of avoid, given the fact that we don't have a clear trajectory in terms of prices. So despite attractive valuations, I think probably it is still not an opportune time to sort of dabble in metal as overall back.
Not be a good time to dabble in the metal stocks for a bit of a medium to long term, but for the day we might see a bit of rebound in some of the metal names. Of course, for the last 5 days we have seen that these stocks have been on the back foot, but of course today it's the Asian market which has been doing quite well. Hang Seng is up over 3-4%, and that after China said that they're looking at supporting the ailing property market, and that usually means good news for some of these metal names as well. But separately, Naresh, if I can get a technical view on some of these metal stocks.
So metals as a basket has done, say, sideways to moves to downward moves in some names and an uptrend in some of the other names. So, for example, if you look at Jindal Steel, the stock is say at 630 odd levels. The all-time highs recently made was 650. 600 was the high previously back in 2023, as well as 570, 580 was in the previous cycle. So you have a Jindal Steel which is doing well. You have a JSW Steel which is doing well. And then you have a Tata Steel which has gone nowhere. So out here the case is stock specific different moves. You have SAIL which is still down 40% from the previous cycle highs done. So out here one has to be very, very stock specific. So the only name which still looks trending up is Jindal Steel. Till the time it holds about 600, you want to buy on a retest of 610 to 620 levels and keep a stop loss at 600. So out of all the names, only Jindal Steel comes in the trending basket.
Okay, so that's the take coming in. But Pankaj, just wanted your view regarding Shoppers Stop as well. The company came out with its earnings, and no surprise that it was another tepid set. The revenue was up around 4%, but the margin performance was better than street expectation. Do you think this weakness about the apparel business sale is likely to continue and not the best time to dabble into these names as well?
Well, yes, I think numbers were a bit soft for Shoppers Stop, largely because when you sort of look at the overall share of private label, that is intact at about 14%. Now, the challenge is that the companies have been offering higher discount because the overall sales have been tepid. And that, along with that, there has been a store addition, so that sort of impacted margins. I think we are yet to sort of see a revival in the overall retail sales. So I think that remains a sort of a challenge in the near term. But structurally, I think we like the retail space as a overall, and I think if Shoppers Stop is able to sort of increase the proportion of private labels, which is a high margin business, I think things will look a lot more better going forward. But near term, we don't see much of a price movement given the results.
Okay, that's the view coming in on the retail space. But time to move on then to stocks on the editor's radar. Today, we're discussing the auto stocks in great detail. Well, we have seen a pretty strong move already on a year-to-date basis. There's been an up move of about 24%, and all eyes will be, of course, on results and the likes of Tata Motors, given the fact that, the chip supply shortage issues seem to have been behind us, etc. There's a lot riding in terms of expectations.
Look, I mean, the auto sector has seen its best first 6 months in last 9-10 years. So obviously it is turning out to be the sector of the year. What has changed for autos? I think somewhere they did not participate in the post-COVID rally. Margin concerns were there in 2021, and in general the industry suffered because of semiconductor problems. And the global companies, they had the issues largely because of the European economy. Last year, because of what happened to Ukraine and what happened in Russia and Ukraine, was in some kind of an flux. Tata Motors numbers are due. Now, everybody would be monitoring these three things: JLR performance, free cash flow, and margins. On free cash flow, they've already given a guidance. So you know which way things are moving. JLR performance, you know that it's incrementally getting better because you get the auto dispatch number. This is the surprise. So if you're looking at the stock now, the surprise element really has to come from the margin front, and also what is really happening to the domestic CV business, because that's where they've lost market share both in the CV market and in the HCV market. So I think Tata Motor will be remembered as a classic turnaround story. But if you're a near-term investor, you got to ask yourself what's next. This what's next, I think, is the most important thing you got to ask yourself every time when you're looking at the numbers. These are the expectations, both sequentially as well as quarter on quarter. But for me, the monitorable here would be JLR margins and what happens to the CV business. We don't talk about it. CV business and what is happening there. Cash flows becoming better, JLR becoming cash flow positive, company migrating towards becoming a net debt. The Tatas, I think, have done a great job in turning around Tata Motors. I'm not taking that away. But in the near term, when you're looking at a stock, especially in terms of positioning, extremely overbought, little bit of disappointment could backfire like it did in a lot of other cases.
Okay, so CV business is going to be critical as are margins, Anisha, when it comes to Tata Motors.
Well, yes, and Nikunj, you're right. Yesterday, TVS reported a largely in line to a slight better than expected numbers, but it saw a bit of a sell-off after the run-up. Will it be the case with Tata Motors today? Pankaj, what's your view?
So I think when you sort of look at Ashok Leyland numbers, the CV margins were quite good at 10%. Our sense is that most of the players on the CV side are reporting healthy margins because of the good pricing discipline, and also the product profile is tilted towards the heavier tonnage, and that is leading to better ASPs. And I think Tata Motors overall, our sense is that will sort of deliver double-digit kind of numbers on the CV margin side. So that I think is a key positive. And I think one more concern was in terms of how the overall capex will pan out, especially on the battery side. So that way, I think with promoter sort of pitching in, I think so that worry is also sort of put to rest. So I think overall they've been sort of firing cylinders in most of their businesses. CV was one lagging piece, and I think last 2 quarters we have seen a revival there. So we are positive on this company. We have a target price of 700 on the stock.
I'm going to put this graphic out, which talks about what's next, the leadership part. For Reliance, the demerger or the price discovery of Jio is done. ITC, the hotel demerger trigger has been played out. For ICICI Bank, results are already out, and for HDFC Bank, the merger has gone through. So Pankaj, which would be the leadership stock now? Because clearly for the 4 names I mentioned, the heavyweights, all the triggers have been played out. What's next? Who will be the new leader?
So I think, Nikunj, banking is still one sector which will sort of continue to do well. I think first quarter, there was an expectation, or first half, there is an expectation that the NIMs might sort of be soft on a quarter-on-quarter basis. But our sense is that overall in the second half, things will recover. And lastly, so NIM sort of contracting probably may not really play out for this year. So you'll see subdued in the first half, but recovery in the second half because of the MCLR benefit. And I think banking, we are still getting good amount of inflows. So banking obviously is one of the pockets which can sort of do the heavy lifting. And I think Reliance, probably our sense is that while retail and even the geo businesses sort of okay in terms of performance, but I think overall our sense is that probably the petrochemical business could do better going forward, largely because some of the input cost pressures might sort of go off. So I think, and then I think IT hasn't sort of, or IT may not really sort of find the triggers from earning perspective. But we have Fed meeting lined up, and if Fed is comfortable not really sort of hiking beyond the current expectation, then I think the macroeconomic scenario might improve, and the overall deals might get converted into revenues in the second half. So that there could be an element of positive surprise. And I think autos continue to sort of do well. So I think overall, our sense is that some of these pockets will sort of continue to fire for the market, and which is why we feel that 21,400 is very much on the cards going forward.
Wow, by mistake, nonetheless, you said 24,000 on the Nifty and our ears popped, but at least we'll be fine with 21,400 as well. But Pankaj, I'm not sure if you tracked Jubilant Foodworks because the company reports its numbers today. Wanted to get a sense from you as to what should one expect there, because on one hand, the footfalls, etc. have been improving, but the cost pressures with respect to cheese and others as well continue to be quite high.
So we don't have a coverage on this stock, so I'll not be able to comment. But yes, you are right that the input cost pressures have been impacting margins, and I think that is still not sort of changing. We are still seeing some of these input cost being at elevated levels. So I think the stock hasn't done much. We really do not expect any near-term sort of big pop-up in the stock going forward as well.